Navitas Semiconductor closed its last trading session on Friday, June 12, 2026 at 4 p.m. Eastern Time at exactly $23.39 per share, marking a significant intraday climb of 5.34%. While a daily spike like that typically sends retail crowds into a frenzy, thinking they have caught the bottom of a massive tech cycle, the true narrative playing out behind the scenes points to an entirely different set of pressures. The expectation among many retail buyers tracking this name is that Navitas is a pure play on the next generation of power electronics, a business catching the massive tailwinds of hardware infrastructure upgrades. Reality, however, shows that the company is burning through cash at a rate that recently forced management to announce a massive $500 million at-the-market equity offering, threatening serious dilution for current shareholders while a key director simultaneously stepped down. This massive disconnect between what investors want to see, which is an unhindered chip stock rising alongside the absolute giants of silicon, and what the financial statements actually show, creates a tense environment for anybody trying to figure out how to value this business. If you are looking at the wide world of tech investing, checking different platforms, or seeking general investment help, you notice how smaller hardware names get swept up in broad market momentum regardless of their internal fundamentals. When you look at how this stock moves on a daily basis, the massive trading volume shifts tell a story of high institutional skepticism masked by aggressive retail options trading. The daily swings have become increasingly volatile, driven largely by the company's recent strategic announcement regarding its integration into the NVIDIA stock hardware ecosystem, specifically the MGX partner framework for megawatt-scale infrastructure. Investors see that headline and immediately treat the company as if it possesses the scale and pricing power of Apple stock, ignoring the fact that Navitas operates in a highly commoditized, cyclical niche where margins are notoriously difficult to defend. This is why when you use an online trading platform like Interactive Brokers to study the order flow or monitor the heavy volume spikes on popular retail channels like the Robinhood app, you see a tug-of-war between short-term momentum traders and long-term value managers. Institutional activity in Navitas has been cautious, with large funds trimming exposure during recent rallies because they recognize the long road to true operating profitability. The first quarter earnings report for 26 highlighted this exact friction, showing that while revenue grew sequentially to $8.6 million, the company still posted a substantial non-GAAP operating loss of $11.7 million. That means for every dollar of high-tech power components they ship out the door, they are spending significantly more on research, development, and administrative overhead just to stay competitive. This constant need for capital is precisely why the $500 million at-the-market stock sale program sent shockwaves through the market, causing a sharp double-digit drop in the sessions immediately preceding this latest Friday bounce. When a company with a market capitalization hovering around $5.5 billion announces the potential to dump $500 million worth of fresh shares onto the open market, it tells you that their existing cash runway of $221 million is not viewed as sufficient to carry them through the intensive scaling phase. Retail investors using basic investing sites often miss these structural shifts, focusing instead on the top-line percentage growth numbers. But institutional players look at that capital raise and see a business that is structurally dependent on equity markets to fund its operations. This macroeconomic pressure is compounded by the broader semiconductor sector momentum, which has been fiercely punishing toward non-profitable firms while rewarding a select few at the top. For anyone managing a portfolio on a self-investing basis or setting up automated allocations through something like Schwab Intelligent Portfolios, the risk profile of a business like Navitas requires a completely different approach than a stable large-cap tech giant. Comment below how many shares of Navitas Semiconductor you currently hold, or if you prefer sticking to the cash flow kings of the semiconductor industry. To understand why Navitas is in this position, we have to look closely at what the company actually does and how its core business model has evolved. Founded back in 2014 and based out of California, the company built its reputation on next-generation power semiconductors, specifically focusing on gallium nitride and silicon carbide technologies. The core thesis behind their product line is simple. Traditional silicon chips have reached their physical limits when it comes to managing high-voltage electricity efficiently. By using gallium nitride, which they brand as GaN-Fast, and silicon carbide, branded as Gene-Sic, Navitas can build power components that are smaller, handle much higher voltages, and lose significantly less energy as heat. For years, their business model relied heavily on the mobile and consumer electronics space, providing the fast charging bricks you use for your smartphones and laptops. But that market turned into a low-margin trap with sluggish growth, prompting management to initiate what they call the Navitas 2.0 strategy. This strategy is a complete pivot away from consumer electronics toward high-power markets, specifically infrastructure installations, energy grids, and industrial electrification.
They want their chips inside the massive power supply units that keep server racks running, because those environments require insane amounts of electricity and cannot afford efficiency losses. This strategic shift is visible in their recent product announcements, such as the high-voltage isolated packages designed for direct-cooled thermal management and their 10-kilowatt power delivery boards meant for advanced server setups. The expectation created by management is that this high-power business, which now represents a large majority of their total revenue mix, will expand margins and bring the company to a point of self-sustained profitability. The reality, however, is that entering the enterprise and industrial space introduces massive qualification cycles that drag out for quarters, if not years. When you sell a fast charger to a consumer brand, the design-in cycle is fast. When you sell a power component to an industrial grid operator or a major server manufacturer, the testing, validation, and safety certifications take an immense amount of time. During this prolonged validation phase, Navitas has to keep investing heavily in engineering and fabrication access without seeing immediate massive revenue scaling. This creates a severe cash drain that explains why past financial reports have been marred by consistent operating losses, forcing them back to the public market to raise capital via share dilution. Investors using standard online investing platforms often look at the impressive performance specifications of gallium nitride and assume commercial dominance is inevitable, neglecting the harsh realities of industrial supply chains and corporate procurement timelines. Looking out into the near future, the path for Navitas depends entirely on how the tension between market expectations and execution reality resolves. There are two primary scenarios that could play out over the next few quarters. In the bullish scenario, the company successfully integrates its technology into major server architectures, and the sequential growth they recorded in early 26 accelerates rapidly, allowing them to hit the high $30 million quarterly revenue threshold required to achieve true operating break-even. If they can prove to the street that they can manufacture these complex high-voltage components at scale while expanding non-GAAP gross margins past 40%, institutional confidence could return, neutralizing the dilutive impact of their at-the-market equity program. On the flip side, the bearish scenario involves prolonged delays in data center qualification cycles, paired with intensifying competition from established chip heavyweights who are rapidly developing their own gallium nitride and silicon carbide portfolios. If larger, deeply profitable competitors decide to price Navitas out of the market, or if the $500 million share supply hangs over the stock like an anchor, the equity could face serious downward pressure, leaving retail investors holding the bag. For individual retail traders navigating these volatile tech names through individual brokerage setups, whether utilizing the convenience of the Fidelity mobile app, browsing options on the Robinhood stock trading interface, or conducting advanced technical screening via the Interactive Brokers platform, the lesson here is one of structural discipline. It is incredibly easy to get blinded by a company's technological narrative, especially when it involves terms like high-voltage direct current architectures or direct-cooled thermal management. But a great technology does not automatically equal a stable, profitable investment if the underlying business model requires continuous shareholder dilution to keep the lights on. Many investors flock to broad financial products, researching Fidelity investments, looking into specific Fidelity ETFs, or picking out specialized Fidelity mutual funds hoping to catch a piece of the broader chip sector. But individual stock picking in the micro-cap and mid-cap space demands a brutal focus on cash flow. When you are looking for investment help or mapping out a long-term plan for a retirement account like Fidelity IRAs, understanding the fundamental differences between a cash-generating monster and a speculative growth play is what protects your capital over the long term. To cleanly summarize the core dynamics at play, Navitas Semiconductor is currently caught in a classic market paradox, where its technological achievements are outstripping its financial realities. The stock's recent daily bounce to $23.39 shows that the market is still highly sensitive to any positive headline connecting the firm to the broader ecosystem. However, the reality of a massive $500 million equity shelf, sequential operating losses, and the friction of long industrial sales cycles cannot be ignored. The expectation of smooth, unhindered growth is consistently clashing with the reality of heavy capital requirements and corporate restructuring. As you look across the entire technology landscape, comparing how different assets behave from a highly traded vehicle like Tesla stock to smaller component plays, remember that structural viability always trumps narrative over a long enough timeline. Keep a close eye on the upcoming quarterly reports to see if the revenue mix from the high-power segment can finally outpace the operational burn, because that is the only metric that will truly decide if this business can stand on its own 2 feet. Disclaimer: this video is made only for educational and informational purposes. I am not a financial advisor. Any stock, crypto, or investment discussed here is not financial advice. Please do your own research or consult a qualified financial advisor before making any investment decisions. Invest responsibly. Don't forget to like, comment, and share this video to support the channel.